Good evening, ladies and gentlemen. This is Clueless Trading Frank. It's approximately 8:24 p.m. Eastern Standard Time on a Sunday evening. This is a free market update webinar. We're going to go through very quickly on a market weekly market update as well as some forecasts. Go through a couple of charts, get people going for next week. We have a low attendance, probably because it's a Sunday night, and probably because Oscars are on, but I never really watched Oscars, so I wouldn't know. This session will be recorded, uploaded to the YouTube Clueless Trading YouTube channel. That's available for anyone out there, for all the free webinars that I put out there for anyone to review, try to understand a bit of what's going on, and to learn a little bit about the U.S. financial markets. So feel free to pass the word on to your friends and colleagues who would like to subscribe for free to the Clueless Trading YouTube channel. Full disclosure, this webinar is for financial education. All my webinars are, and not for solicitation or advice. So on that note, let's begin. We have two terrific members, Mike and Nia Ritchie, here in attendance, and maybe some other people will come in. But let me just kind of roll through a whole bunch of things. What you're seeing behind you is a live screen. It is live because that's the S&P 500 futures, which are down approximately 6 3/4 points, 7 points right now. Not a bad start in the context of what's going on. And you're seeing the visual representation of that here on the S&P 500 futures or E-mini charts right here on a live basis. Okay, this is where we are right now. This is where we were on Friday at the bottom of the market at 9:30. This is where we closed at, and this is where we are. So visual representations are obviously much easier on the eye, and in all cases, you can actually absorb a significant amount of information by looking at the charts instead of just looking at the actual numbers of the prices moving up and down for stocks and for the indices. And I think that's kind of obvious. So that's what you're seeing behind you. So a couple of broad points. We all know, don't need to remind ourselves, that we're in the midst of intense volatility. Intense volatility. It is not the end of the world, but it is very, very sharp volatility for reasons that we all know. The latest reason being the so-called trade wars that might be brewing with the announcement by President Trump on aluminum and steel tariffs, which was kind of known, to be honest with you. You know, he mentioned that about a month ago. But the powerful announcement on the press conference that he was going to go ahead and put a looking to put a 25% tariff on foreign steel imports and a 10% tariff on aluminum imports from overseas exporters and selling into the U.S. markets, sent shockwaves through the U.S. business community, and there was obviously a big backlash by his own, by the own Republican Party, as well as the business community. I don't want to get into the nitty-gritty of it, but I'll just kind of spell out my opinion on the whole matter and the political game theory, what's being played out. The irony of the thing is that his announcement that he was looking to put in this very heavy protectionist measure from an economic standpoint has put some unlikely allies with him in bed, i.e. the Democrats, the labor unions, and such. Okay, who are very supportive of his actions that he is about to embark on. So and Republican GOP free traders, basically that's the platform for the Republicans. They're against it. That's the funny part. Because after all, overall, the mantra of U.S. business is free markets, and having a heavy-duty tariff or taxes on imports, in this particular case for steel and aluminum, sends a shockwave through the system that the government is intervening which in fact it is, intervening in protecting one of our industries, and that is not free trade. It goes against the mantra of markets deciding for themselves what to do, instead of the government coming in. If you want to look at it from a neutral, standpoint, not a political standpoint, the government coming in and telling businesses what they should be doing, right? So that's the bottom line. So here's my take on it, okay? And what do I know? I'm just a clueless guy, and thing. First of all, this is the president is using his bully pulpit to send a message that unfair trade practices, and there are certainly unfair trade practices, and it's not just about China. It is not just about Korea. It is about Canada. Canada, in fact, in China, in fact, exports very little steel on a percentage basis imports cheap steel, exports cheap steel to the United States. It's actually Canada, believe it or not. And the Canadian government has been extremely vocal about it and called it nonsense, as we know. And everyone looks to their own backyard, and they're not, they don't like it, and that's understandable. It's just the way it is. In Canada being one of our biggest trading partners, they are going to be heavily affected, for a better choice of words, if we put that type of tariffs in place. And from Peter Navarro, who is one of the economic advisors currently, and our Commerce Secretary and such, from the Sunday morning talk shows, they're saying that this 25% tariff on steel, imported steel, and the 10% tariff on aluminum will stand. So we shall see. So my take is that this is not the beginning of a full-scale trade war on all fronts. I think President Trump is a lot smarter than that when it comes to understand the ramifications of what this can cause to the global economy, and in effect cause a backlash and a negative effect on the U.S. economy. That's for sure. That's the reason why markets are nervous. That's the reason why we fell almost 600 points on Friday, and then bounced, and then of course we bounced hard. Not on Friday, on Thursday. Fell a little bit more on Friday, as I had mentioned, and then we bounced up like a monster, right? We turned around and bounced up almost 400 points from the lows. So my take is that this is not the onset of a full-scale global trade war. I put up a couple of very important articles that came out this weekend. One of them, that China is openly has put up a friendly gesture that they want to sit down and talk about these matters, which I think is a positive step. And you're going to see a lot of this back and forth over the coming days. And that's the reason why, in my opinion, futures are not down 20 points, despite the fact that Peter Navarro and the Commerce Secretary Wilbur Ross over the weekend mentioned that these tariffs will stand and that they will put it in place. Futures are down right now only 3.5 points. Of course, there's going to be intense volatility overnight. The European markets will be opening at 4 a.m. Eastern Standard Time. Japanese markets will be opening up shortly. China markets will be opening up in the next hour or two. So bottom line is, we're going to see what happens. But whichever the case, I repeat, this is not the onset of a global trade war. This is not the beginning of the end of free markets as we know it. However, this will be a tough trade. There will be tough trade negotiations back and forth. Our steel industry, in my opinion, has been maligned and hurt by dumping, steel dumping. If you want to understand what that means, it has been going on for about 30 years now. U.S. businesses and the U.S. economy, believe it or not, has benefited from that in a big way. President Trump, who being a developer, has built all his buildings using cheap Chinese steel. I mean, face facts, okay? And so have U.S. housing developers and commercial developers and everyone else. So everyone's kind of benefited one way or the other, if you really want to face facts. Unfortunately, it has put our steel industry not out of business, but they've been hurt because for a simple reason, cheaper the better. So businesses take advantage of the cheaper prices of foreign steel and aluminum, and they have basically enjoyed the cheap prices and boosted their profit margins, which in itself has benefited U.S. consumers by maintaining the price of all goods which use a large amount of those two metals. And keeping the prices in a moderate level. So U.S. consumers have also benefited in a large way. However, the steel sector has been, in my opinion, unfairly hurt, and I believe that there should be some sort of tariffs. But tariffs is a dangerous word. You start putting this trade war out by putting tariffs, they'll put a heck of a lot of tariffs on all the products that we sell overseas, and boy, do we sell a lot. Okay, whether it be the aircraft industry, Boeing, whether it be the technology industry, and let's put it this way, our multinationals dominate the world in exports. All right, we're the big daddy. So the bottom line is, if there is a trade war and they decide, the Europeans decide and the Asians decide to really, and those are the two major consumers of our exports, then, and even if they put a small amount of tariffs on, let's say, technology or on aircraft or on all kinds of other products that we sell overseas, then that's not going to be good for us. Let's face facts, okay? Jobs will be lost here, and it's not going to be good, period. But I don't think we're going there, okay? I don't think we're going there. So we'll leave it at that. We'll leave it at that. It is a very complex subject, and one of the things that I like to point out, that what we're seeing is a very high-level game of political game theory. Okay, this is beyond the understanding of the average trader, and this is beyond the understanding of most commentators, in my opinion. Okay, and so trying to sit there and read the headlines and saying, oh, it's really bad what's going on. It's really not that simple. It's really not that simple, because let me put it this way. You go ahead and put 25% tariffs and 10% on steel and 10% on aluminum. You think it goes into effect right away? No, because the nations that are affected by it, Canada, Korea, China, they're going to basically take us to the WTO, the World Trade Organization. Okay, and we are members of the WTO. All right, so and the WTO most probably was going to vote against us. Okay, the reason being that the grounds, the meritorious grounds of why we should be putting these tariffs unilaterally, single-handedly, us saying just, hey, do it, is not going to stand in a court of law. Now, President Trump likes to say that it's a national security issue. In effect, it's not a national security issue. Okay, it's an economic issue. So on that note, we're going to lose, and those tariffs are not going to be put in place, and we can't just unilaterally do that. All right, so there's a lot of layers of stuff that have to happen before these things get slapped down and become permanent law. I want you guys to understand that. All right, I want you guys to understand that. But in the meantime, the markets get nervous because it puts a fly in the ointment in a global economy which is run by trade. We're not isolationists. We're not sitting here, just consuming everything that we're producing. We're selling a substantial amount of our products, especially the big ticket items, overseas. It's a global economy. That's what it's all about. It's always been since the advent of capitalism. So the bottom line is that the markets, so markets don't want this type of, in a recovering global economy with markets doing well. And the markets are still in good shape, and we're going to go through the charts and stuff, everything, in a few minutes. They don't want that to happen, right? If the EU comes out and slaps a 5%, 10% tariff on internet products, right? Amazon, Google, Facebook, all these companies are going to be hurt. It's obvious. Our financial services business, we dominate the world. The Goldman Sachses of the world, the Bank of Americas, but Goldman Sachs primarily, all the other big banks, JP Morgan, these are global players servicing the global financial industry. So what happens if they start putting sanctions against them or tariffs against them on financial products? No good, right? So these things surely have been taken into account. So anyway, so that's the key risk right now on what's going on with the markets, right? And in between that, we're traders. So we're trading these markets. So let me get straight to the point here. When markets get this volatile, up and down, and I will stand by the fact it's up and down. All right, big flash crash, pull back, 400-point move from the bottom, huge profits intraday, no question about it. But there is volatility. Volatility is hard to trade. But for tactical traders, I'm not saying it's easy, but I speak. I've always been a straight shooter on saying and guiding people through messes up and down. The average retail trader mentally disappears, and it's not their fault. Because they get mentally shattered, like, oh God, I bought this, and then futures open down, and look at this, I'm down, and I can't take this anymore. That's the first little voice that goes through their head. Now, there is no way me, as a single person, is going to change that. That's up to you to figure out how you're going to do it. What I'm doing, as Clueless at Clueless Trading, is providing very, very specific tactical roadmaps where you can pinpoint buys and sells and trade accordingly. Whether it be a swing trade, and let's keep in mind here, and this is something I wanted to mention, and I have mentioned that repeatedly on my Twitter feed, because my Twitter feed is a running commentary and analysis and guidance on how you can make money in markets, volatile or not. And it's always been volatile. Let's face facts. Now the volatility is enhanced, but markets have always been volatile. Okay? And more so in the last couple of years with the advent of machines or algorithmic high-frequency trading black boxes, supercomputers, which move markets around hundreds of points in a matter of minutes, if not a matter of hours. We know that. And you all know that too, obviously. And the world seems to have finally accepted it. The media has accepted it. That, oh, yeah, it's this algos, which do this and do that. Well, good. At least there's a recognition and acceptance of the fact that 80 to 90% of the trading on a heavy volatile day is run by machine, and in most cases in a normal day too. So what I'm getting at is my job is to guide people as much as possible within reason through my tactical charts that I structure. You see that right behind you. This is a visual representation of a fantastic, precision tactical chart, the daily chart of the S&P 500, going back to late December. This was late December. This was 2018. Let me draw a line up. This is 2018. The big run up in January, and then the crash that started in February 2nd, 5th, and 9th, and double bottom on the 5th and the 9th. Then the sharp pull up, and then the drop. And the very sharp drop on the tariff news. This was just a consolidation wave, which turned into a very sharp drop on Thursday, which culminated into the very powerful lows, which I said was going to be, the market was going to open lower. We were short the market via puts as a hedge, which worked out very well, but it was instantaneous. It hit there, and within a matter of 5 to 6 minutes, right after the market opened, the market turned, and this was a nice 300 plus, almost 400 point reversal from here to here. This was Friday. So throughout through my charts, and this I stand behind 150%. I am showing exact levels of where the markets can bounce, where they will hit major resistance, because even at this level, I did say we were going to get close to the 2800 level. And I put specific numbers out there: 2780, 2790, 2796. And I also show max upside where we could possibly go if we didn't have the tariff thing break out with the announcement from President Trump. We would have gone to approximately 2812 or so and completed this pattern. We'd have a sell-off anyway. So whichever the case, I'm walking people through exact levels of where the markets are going to go, where they can drop to, Because remember, trading and investing is a game of probabilities. Okay? Trading and investing is not a game of guarantees. There are no guarantees in life to start with. And in this business, certainly there are no guarantees. There are high probability tactical trades up and down. You can trade within the ranges for a certain particular stock, and you can do the same thing with with the indices, whether it be the S&P 500, the Russell 2000, which by the way was monstrous. Okay, we'll look at that chart too. And was the strongest sector because they tend to benefit the most from a protectionist policy, and because they're not really selling overseas, right? The Russell 2000 is U.S. small cap growth, and their biggest consumers are the U.S. consumer. So they tend to be the biggest beneficiaries. That's why you saw a very powerful move on the RUT IWMs. So anyway, so going back to it, I want all traders and members to understand, and people who know me well. Okay, I'm always here to throughout bad, good, and ugly, and you know what? And I'm going to say that really ugly markets. All right, and I'm going to keep on doing my job. The absence of traders, and I read traders like an open book. All right, it's just no traders. I know exactly how people think, what they're going to do when they get happy, and when they do silly things, when they don't do what should be a smart thing to do, make back a substantial amount of their short-term losses, when they're sitting around doing nothing, when they're not looking at my charts, and that's okay because it's up to you guys what you guys want to do. It's not up to me. And I know it's been tough because it's been tough for me too. But in between, we have had substantial gains, substantial gains. So one of the things that I want to point out is if you're looking for an easy market to trade, you ain't going to get one. Okay, you're not going to get one. This is a pure, I said this before in 2017, and this is coming true in a big way. This is the year of the tactical trader. Okay, and it's not just a slogan. It's not like waving a flag and say, okay, this is the year of the tactical trader. This is a fact of life. This is a fact of how your profit and P&L will look like on a certain day, on a certain week. This is what your mental happiness and sadness will depend on. And it's the fact that you have to be a tactical trader. You'll be forced to become one. It doesn't mean you'll be as robotic as I am. And even then I get, swept around. I'm after all human, but your trading practice needs to be what do you call? Sorry, it's I was getting some Twitter thing from one of the members. I don't know what the heck he was talking about. Anyway, so your trading practices need to be more mechanical. Now, how you arrive at that juncture, I don't know, but I'm going to keep on doing my job. You do yours, and it's going to be fine. But if you're looking for an easy market to trade, where you think you can just sit on something and it's just going to magically work out because all the chart setups are looking in that direction, well, it just doesn't happen. But saying all that, what I'd like to point out is that my charts that I put out there and the trades that I put out there, whether on an intraday basis or a swing trade basis, they tend to work out in a massive way. The problem is that a good number of members and traders don't seem to act when they should be acting. And there's nothing I can do about it. There's nothing I can do about it. I mean, case in point, let's say Netflix. This was one of the most bullish charts that I've been showing from let's say this year. We're talking about all the way from the 200 level. Okay, and look what happened here. This stock doesn't care what's happening, whether there's a trade war going on or not. Even though Netflix is expanding overseas in a massive way, so you don't want tariffs put on Netflix content delivered in China. That's for sure. But the stock basically broke out like a monster. Was alerted on Friday. And even here, the charts were fine. This was a large cup. There was a small handle. 1 second. The large cup, big hammer reversal. A handle developed, then a breakout. Okay, cup, handle, 2 days. Big breakout. A nice handle. and then huge breakout, new highs. Or you think it's just going to stop there? No, it's probably going to go to 310, probably 320. So it's just one example of what's going on. So one of the things that I think that all retail traders, all members and traders need to work on is you have to define your mental risk, your mental, whatever you call it. Okay? Because if you are looking to make money in these type of markets, there are many swing trades on the biotech side and some other specifics, but specific selective trades. But specifically on the biotech side, remember one thing, which are working out fantastic. You can have small amounts of options in that. You can own some common. I don't know how much money you're trading with, but whichever the case, you can do. You can stick with those trades regardless of market conditions. Even if they're down $2-3 on a certain morning, they're overall going higher. You know the names. I say it all the time. Whether it be companies like Nectar Therapeutics, which I mentioned several times in the past couple of months, whether it be Blue, whether it be Sage Therapeutics, whether it be AGIO, Sarepta, AVXS, Clovis, to name a bunch of the specific ones that I keep on repeating. So I think what retail traders need to work on is that that when we get to those inflection points in the market, they need to react on that. They can take off their profits at the end of the day, because these days these one specific hammer reversal can make your whole week or your month. It's a fact. So you don't need to be, you can take everything down at the end of the day if you choose to, and they can start fresh that following day. Now, if the market gaps open 20 points, fine. There's going to be a sell program somewhere within the first hour, profit taking. We know that. Or you get these type of little consolidation flag which breaks down because of the tariff news. But then we have this massive 300 to almost 400 point reversal. You got to act at this level. You got to act at these levels, because I am consistently showing the levels where the markets will bounce from based on what I can see. When volatility gets really crazy, I got to follow what the charts are telling me. And each chart will tell you a different story. The short-term 1 hour chart will tell you a different story compared to the weekly chart, which will show you that, hey, there's a little bit more pressure coming down. We could be going down more. And we're going to look at that quickly. So that's really where I'm coming from. The level of despair that retail traders endure because of this volatility, and volatility is not meant to make you happy. It's meant to give you some opportunities to make some decent money, but it is primarily designed to completely mess with your brain and just make you just disappear. And that's what happened with retail traders. There was not a single person, maybe one person on Friday, and it's okay. It's okay in the chat room. But on a day that things are good and everything's flying, and everyone wants to chase those stocks going higher, and I'm saying sell 80% of your tactical profits and stuff, those days it's chat rooms buzzing, which is fine. But that's not the day you should be really excited about it. You should be looking at opportunities to buy and trade within that same day, or maybe within the next day or two, by buying at these levels. But the excitement from the retail trader is never at these levels. It's always at these levels. And I've always asked myself, why? These are the levels, what we call shooting fish in the barrel, because you bought these consolidation lows. These are the levels that you are basically shooting fish in a barrel, just taking profits at will. Excitement and those perfect moments should be at these fat blue arrows, at these arrows. And these are the times, unfortunately, because that's human nature. But human nature is not going to help you survive in world of investments and trading. Because investment and trading, you have to switch opposite. These are these levels where you should be excited because the price is just dropping towards you. Even if you bought a little bit earlier and you're an hour early, who cares? You can't just always buy the lows. Even though I've pinpointed so many times where you could buy the lows, which I did on Friday on multiple stocks. So these are the points where you should be just happy to buy a little bit. That's supposed to be a tongue sticking out. I'm not a good, cartoonist with my sitting here with my Logitech mouse. So these are the levels that you should be smiling and saying, you know what? I know I'm not feeling good because I'm down in a couple of positions, but I can make up a real decent sum of money buying the apples, which I said at the lows it was going to go green. And boy, did it go green, go well beyond that. And multiple stocks. Google, Tesla. Somebody, a member came in first thing in the morning because that's a human reaction. Oh, Tesla's going to go below 300. I said, no, it's not. No, it's not. So Tesla was alerted on Friday, just giving an example, around 322, 324. Well, 322.97 was the low. So somewhere between 323 and 325. Tesla went to 335 and closed at 335. That's just on one stock, a $10 move. Options went berserk. Tesla options on the 325s at the low were $8. So let's say you got in at 9 or 10. They went to 13. That's 30%. Not bad. And that's just moderate example. The 330s were at 560 at the lows. Went to 10. Netflix was 446 at the lows, the 290 calls. They went to 14. Apple, $1.82 to 314. That's almost a double. And that's on the 175s. The 177.5s went from 78 cents to $1.78, more than 100%. Google, they were a little bit pricier. The 1075s went from, well, it shows 49 cents. It wasn't the case. It went from about $7 to 12. The 1080s went from 9 to 19. Bank of America, let's say somebody said, no, I don't want to buy these $6, $7 calls, in these type of markets. Okay, understandable. Bank of America, what's the excuse for that? I alerted in the low 20 cents. They went from 23 cents to 55 cents and closed at 52. Do the math. Up more than 120% on lottos. Same thing with a whole bunch of other things. Forget about the SPY and the SPX and the IWM and the RUT. I'm not even going to go there. They just exploded. Look at Twitter. Lottos. The low was 70 cents. Went to $1.25, closed at $1.18. Well, these are monstrous numbers, guys. Chipotle doesn't care because that's a swing stock. It's going. Low was 350, went to 661. That's almost 100%, the 325 calls. For next week. Not even for the same day. And these ones that I'm mentioning are, a lot of them are not even for the same day. The same day intraday lottos, which I didn't touch, were up almost 200% plus because they were expiring the same day and the shorts were getting blasted right off these lows. So the point that I'm trying to make is that traders need to find themselves. They need to find what their mental risk is. They can't be just like, oh, these markets are finished, whatever. I'm going to keep on, because I don't want to waste my time being a psych counselor here, but I'm going to keep on showing the charts where I think what's going to happen, and these precise levels that people should be buying and selling, where people should not be getting excited at, which is when they're approaching these type of levels. They should be excited here, but I never see anybody really excited to buy these lows, which is actually great, which means the market remains in a state of despair, which is good. That means the markets are oversold, because happiness and euphoria causes overbought markets. And we haven't seen happiness and euphoria in the markets in a long time. But short-term technical traders tend to get very euphoric when right towards the upper end of a reflex bounce. These are reflex bounces, which happen. This one is going to happen soon. This has already happened, and so these massive reflex bounces are where you should be selling, not buying. Even though you can move with the momentum as the candles expand, but as they approach those levels where all my lines are drawn and it's going to hit, well, those are not times to be happy. Those are times to be taking down profits, and the times where you should be biting your teeth and getting excited to buy cheap prices is basically at these levels. That's all I got to say. So on that note, I really wish everyone well, and let's move into charts. That's all. Okay. So first of all, this is the trader's ultimate chart. I've been showing this. I've been tweaking it. I've been finessing it, and it's just worked out perfectly. Okay. Each of these candles that happen is either the happiness index or the misery index within a certain day. All right, but within the framework of that, the algos are moving so fast, they're moving the market so fast that in my opinion, you need to keep trades within a moderate level so you don't get blasted out. You can't get too happy. Getting too happy to buy would be down here. Okay, but this is the inverse head and shoulder, which I clearly pointed out. Even write it down. I mean, I can't do anything more. So this is your head, this is your left shoulder, this is your right shoulder, and the markets basically went up big time. And then this huge candle, SPX calls and stuff, when stocks started to move up sharp. And then right after that, there were two sell candles. So within the framework of that, it still remained the inverse head and shoulder. So the markets wanted to go higher. It did. Hit that exact level where there are 4 red arrows. I'm basically showing this on kindergarten style, okay, grade 1 style, so everyone gets it. Red arrows, what does that mean? That's your upper end of the range, which is around 26.85. And guess what? It hits that, and within 5 seconds, it sells off. So you don't need to wait till it gets there. You can basically sell around here if you're a buyer around here, because you know it's going to hit it there, and there's going to be at least one active algo HFT sell program that's going to be a heck of a lot faster than you and me can react. So you can put some sell limits out there, sell orders out there, whatever the case, or you can sell a little bit early. It's not rocket science. So right there it fell, and it fell really sharp. The market dropped like 100 points right there on that candle. This is Friday I'm talking about. And if anyone cared to look at these charts, they would know what I'm talking about. So, and then it hit the left shoulder, right shoulder, and then it bounced. And then this was the big short squeeze at 3:30. Monster short squeeze, because shorts were like, whoa, hold on a minute here. This, I'm gonna close out some short position because the market's acting too strong. And let me zoom in. No, actually, that's fine. I'll leave it there. And so all these are great trading opportunities. So if you're looking to be a short-term trader and looking to make those 3, 4, 5, the type of percentage ROIs that I just mentioned to you, and just few of the stocks, then you want to trade this chart. This is the 15-minute chart. So it's showing you more of the closer zoomed in view, and you don't need to be trading with big money. You can trade with some small money. Buy 1 or 2 calls. How much money does it take to buy 23-cent calls on Bank of America, which you could have more than double during the day? I mean, you got to think, guys. You got to think, all right? Actually, don't think, just act, because thinking too much won't do anything for anybody. So you can stick with the lottos. All right. So it gets there, and then this is where we are right now. Right now, as we speak, at 9:04 p.m., futures are down 850, but we're still okay. We're still okay. You can see, these Bollinger Bands are not there to give a effect, like a photo effect when you're doing on your iPhone, right? Like, oh, I'm gonna put some filters on and make, I do that with my dog's pictures all the time, right? Like, put it up there, like, okay, make him look cuter. No, these are the real deal. Look at the Bollingers. The Bollingers are curving higher. That's why it's called Bollinger Bands. For the exact definition of what a Bollinger Band is, it's not a photo effect, guys. It's totally relevant and correlated with the prices of the indices or the stock, what range it's traveling in. The range is still moving higher. Does that mean that we're not going to open down here tomorrow morning or at 4 o'clock in the morning when my eyes kind of open up and like Europe is opening up? I quickly look at it. Either I say, yeah, oh God, or I say, wow, look at that. All right. And then maybe I'll send out a tweet. I'm almost like Donald, right? Like in the middle of the night, like sending out tweets. He doesn't do middle of the night tweets, right? So, so, so bottom line is that no, it doesn't mean that. But at least I have a directional roadmap of where I can react to things. I know that this is the trading band at this point. And you guys know that too because I'm updating this all day long. That's your trading band. Not that hard to understand. And that is a wide trading band. It's close to 2,700 here and 2,600 and change here. That's wide. That's 150 points, roughly, right? I'm sorry, 2,650, 2,700. That's 50 points. That's almost a four. This is a 400 point, roughly a 400 point. Excuse me, sorry, guys. Plus minus Dow Jones trading point. So if you already know what the trading range is, then you don't get panicked as much, or you don't get like, oh my God, look at the price, like, oh, we're just falling apart. Oh, look at this. Why did this happen? Look, volatility will create massive confusion. The question, why did this happen? Don't worry about it. A lot of things will happen. There'll be tariff stuff. China will say something, or North Korea will lob a missile. I mean, it's all going to be there. But through that, you can still make money, which I'm consistently showing. Does it mean your P&L is going to be beautifully green every day? No. But net, you can still make decent money all through the week. To repeat my point, 2018 is going to be viciously, violently volatile. This is a tactical trader's market. Don't want to look at my charts, the structures I make, the exact levels that I say market's going to go or not go, where we can fall to, where you need to react, which brings me to an important point. Okay, which brings me to a really important point. When the markets were selling off on Wednesday, I did some stuff on my side, but I purposely didn't put out major short puts, SPX puts out there because the markets were so fast. I want to be very clear about this. Because the markets were so fast, nobody was really bothered to do anything other than to scream and say, oh my God, look at this, the trade tariff is going to kill us, we're going to be living in caves again in the next. So I said, I'm not going to do that because the fast markets demand that you take some personal responsibility on doing some of the trades yourself. That's why the charts are in place. That's why these levels are drawn. So if you see, I had a thing here, just to remind everyone. This said the bull kill zone. Remember that? Obviously remember that. It's staring at you. So if it's the bull kill zone and the market's trading this viciously within the bull kill zone and then breaks down, well, you could go out there and short the market. I know many of my traders who do that on the side. You could do that. But I knew this was going to be a vast, vicious, and fast sell-off. I did a couple of short SPX SPY trades on my side. There is no way, and I want to make a point of that, in extremely fast volatile markets where things are happening in minutes, will I put out alerts out there on the short side or on the long side. Why? Because the reaction time is going to be so fast that you won't that I won't be able to tweet out, sell this here, buy this here, take profits here. That's why I put out my charts. So if you see that the bull kill zone has been violated below the range here at 26.96 and this big red candle is falling below this downtrend channel. Remember this downtrend channel? This downtrend channel is what we entered and then went towards here. So it is up to you to do what you need to do. My charts alone, you can trade off. You don't even need my trade alerts. So I just want to make a clear point on that. In extremely fast markets, I cannot physically put out fast moving tweets, period. Because if I said I said the markets were going to fall. They're going to fall a bit more on Thursday. We went in short at the end of the day because I saw the power and I knew that it was going to pull back towards at the beginning of Friday. And it pulled back nicely at the beginning of Friday. So those puts worked out nicely. Even though if people were not careful and did not take some of their profits, let's say if they were short here on Thursday, then Thursday we had a very vicious bounce and those puts shrunk in price. So those type of very fast tactical trades you got to do on your own. That's why I'm delivering these real-time charts. Otherwise, I could deliver 3 charts during the day, couple of trade alerts, and just go away. I don't do that. I stay engaged. But engaged doesn't mean I can walk people through up and down, fast-moving, super speed markets, uber fast markets at and through every 15 minutes. Can't do that. So on and then on Friday morning, the markets opened down, so those worked out fine. So whoever did it, made some decent money, and then we went long because that lasted literally 20 minutes. All right. So this chart, so this is a 400-point range right here. This range here is from 2,700. I'm just rounding off the numbers to 2,730. So that's another 200 points. 200 points. Okay. These are the ranges the markets are going to trade in. Futures are down. They were down 3.25. Now they're down 9.25. Does it mean anything? No, it doesn't mean crap. Because what is happening here is what I am going with. Futures can open down here tomorrow morning. And no one's going to be in sight. Okay, everyone's going to be AWOL or MIA, right? Missing in action. That's fine. But at least I know that if they hold here, we're going to get another vicious bounce. That bounce might end right here at the 2670 level, the right shoulder. And then this could be the range that the market travels in for the next couple of hours. But if it breaks out above that, there's going to be another major resistance at this very large downtrend line. So that's why understanding basic tactical trading through the way I draw the charts is going to save you not only money, it's going to help you make money and take off some of the anxiety that a majority of you go through because all you guys are doing is looking at the prices of the movements in the market without any idea whatsoever what the ranges or the structure of the markets are. And the algos love it because they want all of you to be in a state of constant fear and confusion so they can make all the money. It's a fact. Capitalism is not about and capitalism in the markets. I'm not talking about trade wars and stuff. Capitalism in the markets is not about the machines doling out money to you, free money to you. You want to make money, you got to fight for it. You got to really fight for it. You got to pay the price for it. You don't need to pay the price for it by doing stupid things. You need to pay the price for it by being mentally prepared. And the only way you can be mentally prepared, in my opinion, in my experience, because I've gone through it, I still go through it, is to basically focus harder and harder on these charts and the structures that I draw because they will allow you to make money. So this is basically the trader's chart. Or if somebody's not trading, like they want to sit back. And that brings me to another point. On a heavy volatile day, maybe you don't want to trade. Fine, that's good. You don't have to trade every day. Even though the opportunities could be huge on volatile days, which I've repeatedly shown. But if you're waiting, but here's the other thing, which I really want to make a very strong point on that. Okay? If you're waiting for some all clear sign, there is none. And I speak the truth. I am not lying to you guys. If you're looking for an all clear sign, what's an all clear sign? Look at the face of this market since what's the date here? Since the 27th, since the end of February. Okay? Since the end of February, when we hit that 2780 level, right here, where I said the market would go. Close towards 2,800 on the S&P 500, which it went to. Okay? Right there. On the futures, it did. So this is your face of volatility. Moving within a downtrend channel, breaking down, trying to re-enter, hits the downtrend line, big head and shoulder, big move, now within the range. So if you think that by staring at prices on individual stocks as well as indices is going to help you make money, you tell me just by looking at prices how you can do that. I will never draw a single chart in my life. How about that? Look at this. This is machines creating a structural pattern that I am deciphering, analyzing, drawing my lines on it and patterns and showing it to you guys, so you guys don't completely land up at the bottom of the Niagara Falls or the canyon and not being able to get up. This is the face of volatility. So if you're waiting for a repeat again, in the simplest terms, if you're waiting for that quote unquote clear sign, there is none. Stocks are trading within ranges. Some are breaking out. Some are staying, within those ranges. Some are creating new patterns where you can set up the swing trades and just sit on them, like the Chipotles of the world, like even Win, and many other examples. Lots of the biotechs which are creating high-level bull flags. That's it. So this is going back to it. There is no green flag the market will ever wave to you. The only green flag the markets will wave to you is when I put out these big fat blue arrows. Okay? You don't want to take advantage of it? Well, I'm sorry to say. I'm just sorry for you guys if you don't. Okay? Now, at this point, what it's looking like, if things work out, and this is going to be a very important, well, not every week is important. I shouldn't even use those same cliches. This is going to be a very important week. Every day is important. And this week is more important because we have the final decision on the tariffs and everything that I explained earlier. Understood. But isn't every week the market picks up one theme that they should bounce on? One was about the Japanese yen. Then it was all about jobless, jobless. There's no job numbers being created. Then it was the rate tantrum. And through all this, the 10-year bond, like I said, pulled back to 2.857%. And if anyone bothers to look at my webinar from 2 weeks ago, and I said the 10-year bond would hit close to 3 and then create that consolidation channel. Well, ladies and gentlemen, that's exactly what it's doing right now. Okay? So then one week it's about one vicious week. It's about the volatility, the vol trade blowing up, where the fixed shorts basically, died. So every week there's one theme they're going to pick up on. Now it's the trade thing. Now, do you think this is going to be a permanent cancer on the face of the U.S. economy and the global economy? Absolutely not. And like I said, and I will take full credit for that. I'll basically, be the big macho man here. When it comes to global economics and macroeconomics and stuff, please trust me. I can beat any of you to the punch on deciphering every single one of those issues and making my argument stand. Now, doesn't mean that you guys shouldn't be understanding it. You have your own opinions and stuff. That's fine. But I'll tell you one thing right now on this Sunday night webinar. I'm glad some of you showed up. This is not going to be the onset of a long-term global trade warfare. We are not that stupid. Trump is not that stupid. There will be friction, and the Chinese will talk. The Canadians will sit down at the table. Because don't forget one thing. We are the world's biggest consumer of their goods. So where are they going to sell to? Mars? So we can't go in there and say, you better listen to us and stuff, because that's not how things are done. Okay, we're not dictators. But we can make our point, and as long as it's reasonably fair, they'll meet us halfway. End of story. So looking at this larger pattern here is, if things work out on the bullish side, it's going to be choppy, volatility. Then it is starting to look a bit like a inverse head and shoulder with a very powerful support at that 2646 level, which if it breaks, there's going to be another waterfall decline down towards 2600. We'll look at the SPX chart in a minute towards the end of this webinar. And then if this resolves itself, that's the most you're going to go. 2730. Trade the SPYs, trade the SPX. Don't want to trade every 15 minutes, which I don't recommend anyone to do unless they're active traders, because big money can be made in 15 minutes too, right? On the short side and the long side. But this is basically the pattern which will resolve itself. Once it hits there, there's going to be another big sell-off. Or if things get somewhat resolved, because there are some positive aspects of what's going on. Trump is willing to talk to North Korea. Okay, put that out there. China is ready to basically talk, trade negotiations in a tough, open way. Perfect. Earnings have been very strong. Perfect. Everyone's dead scared, hiding in bunkers. Retail traders from Clueless 8 to other places are just non-existent. That's perfect. Low sentiment, no euphoria. Perfect for overall setups for like a bottoming process, short-term bottoming process. So going forward, it's all about ranges, all about patterns. That's it. So that's where it's going to resolve itself. On the lower end, you got this level here. And I told you, this is the 400 point plus minus, and this is 200 points. So we got a maximum big trading range from in March, or at least till the middle of March, of 600 points. So now you know. That's it. All right. Let's look at the daily chart here. Now this is more interesting. It gives you a bigger picture of what's going on. Now these are the stows, all right? The stows here, basically when it reached that unheard of level here, we created a double bottom, and this was a positive divergence where we had the same level being retested at 25.25 back at the first part of February, but we had the stows basically making a higher low. That's known as a positive divergence. Not that hard to understand. The aftermath of that was, and I went through this very, very clearly on my previous webinar, so, we had multiple candle expansions in between, pulling back during the day, shooting higher, pulling back, shooting higher, after pulling back. So, but if you look at it, it was powerful. Hit that upper end of the range where you met with some consolidation or big time profit taking. Okay, lasted 3 days, and then bang, bang, bang. Right? So the bang, bang, bang hit us towards the 2800 level. Remember, 2791 on the E-minis is roughly 2800 on the S&P 500. Exactly what I told people. So I repeat again, time to get excited, to get cheap prices, big sales are the lower levels. Not here, guys, not here. Every time I hear somebody scream that, that things are just going to go to the moon, which people don't do anymore, because they know I'll probably bust their chops in a humorous way. But anyway, it's time to sell. So bottom line is, nobody wants to think that things can really go higher. So anyway, so here we are. So looking at the daily chart, we are seeing what we're seeing. This downtrend line was drawn. We hit that downtrend line almost precisely on Friday, and this is where we are right now with futures down 950. Now, these stows are telling us that we have a little bit more downside left. Now, this downtrend line, this line's been drawn, but forget about that for a minute. So you can see this one if it gets down here, that means we'll be down another 200 points. Is going to be another massive buying opportunity. This would bring us down to what I thought we would get down to on the lower end, which is approximately 2600 or so on. Not 2600, but it basically bring us down to retest around 2645 or so on the S&P 500 right here, maybe slightly higher. Don't want to get into the arrows and the levels are there. You guys got to look at your own charts. So this is telling us that the selling's not fully over yet. And we'd like to see this stay around here and bounce, or have a sharp move down. One of those big volatility sells, boom, down 300, 200, bring it down towards the 2 level. That's the perfect buying opportunity. So then you get this big reflex bounce. So that could bring us into the low 2600. We don't know yet. This is where we are right now. So far, this is very positive. Now keep in mind, we're following what we call the follow-through day. Remember the follow-through day? Day 1 after the crash is this. Day 2, day 3, and on day 4, you better be up, because that's going to trigger a swing type of rally despite volatility during the day. So let's look at the same picture here. This was day 1. This is the day the market crashed. So day 1 was here, day 2, day 3, day 4. So let's count this. This was day 1, Friday. We don't know what's going to happen tomorrow. This is the futures for now. So this will be day 2 tomorrow. Whatever day 3 is, we don't know yet. But day 4, which would bring us to what? Which would bring us to Monday, Tuesday, Wednesday, Thursday. No, Friday was day 1. Monday would be day 2. Tuesday will be day 3. Wednesday will be day 4. So basically by Wednesday, we need to see, but Wednesday, day 4 approximately is Wednesday, we need to see a green day. A green day. That's called a follow-through day. That would portend and trigger a rally which would bring us back towards that 2800 level. End of story. Simple. It's simple stuff. Okay, simple stuff. Otherwise, if somebody wants to look at it in a much bigger picture, we could do this. Could be trying to make a move, and then bang, we come and retest the 2500 level. The next time we go to the 2500 level, and if things are not just completely unraveling on the global political economic front, then we will get another massive opportunity, which many of you, and of course many out there as outside closed trading, completely missed out. So that's it. Okay, let's take a look at S&P 500 on the Thinkorswim chart. So this is what's happening, ladies and gentlemen. This was end of the year. There's a big sell-off on the 29th of December, if you guys remember. Started off with January and I said, buy that. We bought moderate amounts. Market opened up on the 3rd, right? Or so. January. Boom. Kept on moving. In between volatility during the day, but kept on moving. And then, so what did mom and pop do, which I explained in the last webinar? They shoved in big money. Big money. First time you saw real inflows into the market. I bet you they put big money mostly around here. I can almost guarantee that. And then you saw the pop, boom, going towards the 2900 level. Now this is the S&P 500. At that point, technically, it looked like that was a bull flag breakout. But no. Market's all about fake outs. At the end of January, you got this big fat sell-off, right? Big fat sell-off. The VIX implosion. It started off like that and then crash. Unheard of, unprecedented, right? Walked everyone through it. Was it easy? No, absolutely not. It was disgusting. Market fell like 1,500 points. Did mention a bunch of intraday SPX puts and stuff, which went berserk. Anyone took advantage of it, made some real decent money. Whichever the case, we created a powerful double bottom, which is not shown here because this is the SPX chart, not the, a lot of bottoms and technical formations are created overnight. That's why you don't see that double bottom that I showed you on the E-minis. Whichever the case, substantial, a huge, powerful hammer reversal on the 9th. And this is where we are right now. Now, Friday's, please concentrate on this candle here. Friday's reversal was, in my opinion, significant because Can somebody tell me why, in simplistic terms, forget technicals, why Friday's reversal was significant, aside from the fact that we were up, 300 plus points from the bottom, and I said we would almost go green, which we did on the Dow Jones. Can somebody tell me why Friday's reversal was significant? Forget about technical levels and stuff. No? Nobody? Want to attempt? So I'll repeat my question again, and give it a shot. Okay, just asking. So why was Friday's reversal so significant? Which you can see in the form of this fat bullish candle. Nia said, why was Friday's reversal significant? What does no real fear mean? There is fear penetrating every single trader out there. What do you mean no real fear? I'm just curious. What does that mean? Everybody's scared. Can you explain? I mean, I'll take the answer. What does no real fear mean? Maybe I'm misunderstanding what you just wrote. Okay. Anyone else? Trent? All right. We're not going to waste time looking for it because nobody wants to respond. That's fine with me. There's a lot of fear, guys. Okay. It's not just fear. It's terrifying fear across the markets. Ask yourselves, if there was no fear, why didn't you make tons of money on Friday on my alerts? Of course there is fear. Friday's reversal in a simplistic term was, in general, Fridays, the funds, the hedge funds, the margin sellouts, the average retail investor, they all like to sell. They're so scared of the weekend, what's going to happen, especially after that type of massive sell-off, they don't buy on Friday. So it was interesting to see that on Friday we had that type of reversal. Markets generally sell off on a Friday, sell off on the early part of Monday if they're going to have a major reversal, and then they start to recover. Okay, so that's why I found it interesting that there was this massive institutional buy programs that went into effect on Friday. Okay, given the fact there was no real rebuttal of the trade tariff talk and anything like that. So anyway, so looking at this pattern here, and in the question on, and I appreciate the answer, the no real fear, but it made no sense whatsoever because there is huge amounts of fear. And just ask yourselves. That's all you got to say. All right. So by traders, institutional traders, media talking heads, you name it. So so looking at this picture here, everything is drawn for you guys to, see. If we fall the 2640 level, this is S&P 500, so you don't need to convert it to any, any number from the E-minis. You're looking at approximately 2640 or so. Let me clean this out. And that would be, and the reason I drew this line is because so here was the level we stopped at, because remember, this is the level of this was the level of a major bounce, and that's the level we stopped at, which also happens to be the 20-day moving average. Now you guys can see all this on your own screens too. And so right there, see? And it's inevitable that you're going to get some sort of minor pullback, and we're getting that after hours, which is a down 10.5 points. But this is where we are. And so at this level, a major support level, based on what I can see, comes into play at around 2640. 2640. So where we closed at is 2679 or 26.8. Yeah, let's go. 2640 is 39 points lower times, let's say 6. So we're talking about another 200 to 234 points, and this candle will look blood red if we come down here. Now, given the amount of money that went in on Friday, Is it too difficult to assume that everything will be given back? I don't know, but I don't think so. So even if we have a pullback, and if the body of tomorrow's candle stays contained within this large body, or within this large body of this candle, in other words, the 300+% move from the bottom, if this is contained, then you will have an update the next day, which would be Tuesday. But so far as I can read it on the daily, bear with me, go back a little bit. We are getting substantially oversold. We are not as oversold as we were. We are basically down to the levels we were at here. That's where we are right now, close to it. That's a positive development and also a positive divergence. Why? Because we are well above where we were here. We're 125 points higher. On the Dow Jones, that relates to 750 points higher, right? Between the 9th of February and the 4th of March, which was Friday. Was Friday the 4th of March? My apologies. Friday was the 2nd of March. Okay. That's 750 points higher. Yet, if you look at the internals, this is why technicals are reading the heartbeat, the EKG of the patient. All right. The false stochastics are almost at the same level. So we're testing deep oversold, extreme fear, extreme oversold conditions, panic conditions, yet we are 750 points higher from the last time we reached these levels. Everyone understand that part? That's known as a positive divergence. Now, positive divergence generally on the daily take about a day or 1 to 3 days to play out, and then you get boom, kaboom rallies. So you need to position yourselves as we fluctuate between these levels here, if we get below that, and position yourself to enjoy this type of move, which we call again shooting fish in the barrel. You do not get the big game hunt if you're a hunter, or if you're a fisherman, or you're out there fishing, trying to nail the big whale or the shark. You don't get that by going in on a 5-minute move. You want to place yourself, do the straight setups, and wait for that 24 to 48 hours where you get those big, huge 20+ point type of S&P opens, and you just sell. So in order to do that, you got to set yourself up. That's why setups are important. So this positive divergence, can everyone hear me, or am I just like talking to a wall? Just curious if everyone can hear me, because did everyone understand the positive divergence part? Okay, Trent, you got it? Okay, cool. Good. I wasn't sure, because sometimes you get the disconnections, right? And I don't know who I'm talking to. I'm just talking to my brain, and my brain's telling me, shut the hell up. I don't want to hear you anymore. So wasn't sure. So thanks for responding. So this is where we are on the swing trade front. All right, on the swing trade front. And if we fall apart below this line, net again, we will kiss that upwardly rising. Remember, I said that a long time ago. This 150-day moving average is critical. This 150-day moving average, if we zoom out on the daily, is still so far trending higher. When this baby starts to turn like that, I will be net truly intermediate term bearish, period. Because the 150-day moving average is such a powerful line beyond, the 200 and all that. It's such a powerful line. The 200 is important too, but the 150-day moving average, when it starts to curl down, that means every single rally needs to be viciously sold and shorted. But we don't see that yet. So despite all the heavy bearish sentiment, the trader apathy and despair, the real fear out there, the constant negative media bias and everything, the technicals are still, for now, intact. And as traders, we rely on technicals. So looking at these lines here, as I always point out, and I even draw these out for you guys to make it easier for you, that's your 34-day moving average at 27.48. The 50-day moving average is at 27.36. So the last chart, did people get a chance? Actually, I'm not going to even bother asking. You guys do what you want, but for your own benefit. At the end of the day on Friday, I was exhausted. I just wanted to be with my family, wanted to have a nice dinner and stuff. But I sat there and I put out these precise tactical charts at the end of the day, Friday, end of the week. So you guys, with pinpointing where the markets might bounce to and whatever. So appreciate that. Respect it for your own benefit. It's going to help you guys because I'm doing my job. Okay? Do yours. So saying all that, the 50-day moving average is at 20. So what the final thing I was going to say was it is up to you guys if you want to take a look at it. You don't have to take a look at it after the market closes. Maybe you want to take a look at it on Saturday morning or Saturday afternoon or Sunday morning or Sunday afternoon, but it is there. It is there. And I put it out there for the sole purpose so you guys have some sort of idea what the heck's happening on the technical basis. Okay, so the 50-day moving average is 27.36. If we bounce from here to test the 50-day moving average, which is almost always happens, right? We lose the 50-day, then we go back to kiss it. We get rejected there, see you later, right? Same stuff over and over again. So if we're 26.91 and we get to the 50-day moving average at 27.35 or so, or 27.36, you're talking about 45 points, right? 45 points. So 45 times, let's say 6, 270 points. So from here, if we are going to retest this, it is going to be a pattern like this. And that's going to be formidable resistance and maybe an overshoot to 27.48. So from here to where we closed out on Friday to retesting the sideways moving. It's not uptrending anymore, guys, mind you. This is sideways moving. Both the moving averages are now starting to move sideways. That's why it's a very critical point in the markets. Because when they start to turn down, you're going to see multiple sell-offs again. Quick rallies, multiple sell-offs. The primary trend will change if they start to turn down. Now the primary trend has gone from being very bullish to flattish. So we're at a very critical juncture. So bottom line is, I'm talking about these two lines here. So from here to here is 270 points. So if you want to trade 270 points on the Dow, starting where I told people to buy, for a better choice of words, on Friday, then you're going to do extremely well. Or from wherever the market lands up tomorrow. This is where the markets will go. So if the markets pull back tomorrow, futures are down 12 right now. But let's say the markets pull back about 100 points tomorrow and then decides to bounce. If it does this, then you got some substantial profits to make. You got to stay tactical. That's all I got to say. Don't keep on ignoring my charts. Keep on ignoring the structures I put out there. It's just going to just mentally and on your P&L just decimate you guys. All right, just letting you know. And it doesn't mean that we can have, that we don't, we won't have losses on position and stuff because something stupid happened. That's a given. But you keep on doing the same price watching stuff going on with that without really focusing on the charts, then obviously it's going to be difficult. But anyway, you know what I'm getting at with the S&P. Looking at the Russell 2000, so we're good with this. Any quick questions on the S&P 500? No? Okay. Let's look at the Russell 2000. This baby is a really, really powerful chart. We had a big day on the RUT IWM. I'm the first one to say, wish I had more. But look at this. This was a huge candle. It was down here when I told people to basically, not exactly at the low, but somewhere around 1494, 1495, as I started to see this tail develop. Because you got to see the development start, right? And I said, get in there. It's going to go to 1530. I said the 1520, 1530 calls. Guess where it went to? 1533. You can't get any better than this with actual trade alerts and projections, guys. Now, if you guys are not trading the Russell 2000 or you don't like buying the IWM, you don't care about US small cap growth, well, that's your prerogative. But the point is, this is a very powerful index and it moves in increments of 10 to 20 points on a good day. That's the RUT. So if you'd not traded before, highly suggest you start, testing it out. A lot of traders have a very large deficiency or fault. Retail traders. I've never traded it. I will never trade it. Like, what the heck does that mean? I've never heard some traders do that. Oh, I never trade biotechs. I've heard that many times. What? Like, who cares? I never traded biotechs like 5 years ago. Not really. Now I kind of specialize in a lot of biotech stocks. I actually can have a decent conversation about somebody on the technologies on the emerging technologies in the biotech industry. So what does that mean? So cut that mental, block out. Just because you haven't traded something doesn't mean you can't trade it or invest in it. So looking at this here, the 50-day moving average right now and the 34 is at 1550. So that's just around the corner. That's you're talking about 16 more points. The downtrend line comes into effect at 1570, 1557. All these are money-making opportunities right there on the daily. This is your big uptrend line, and that's at 1573. When it was all the way down here and I told people to buy on this big monster hammer reversal on the 9th of February, and it continued forward, the trade lasted 1, 2, 3, 4, 5, 6 days. Quick thing you guys should remember as traders, multiple power vicious reflex bounces do not last more than 6 days at one go. Okay? You can count it yourself. 1, 2, 3, 4, fifth day it faltered a little bit. 6, it pulls back on the 6th day a little bit, and then if it wants to go higher, we'll create another candle. Here it was a vicious bounce. It's 1 day starts here. This was the day, I'll count this. 1, 2, 3, 4, 5, 6. So if it does, let's say it's 4-day move, because normally it's a 3-candle move. So it is going to go there. 1, 2, 3. So it'll take us up there. And if it wants to continue on 6 days, possible, then you're looking at 1580. That's a lot. 50 points you can get on this baby. On the calls. You can do the same thing on a cheaper way doing the IWM, which is the ETF for the Russell 2000. Let's take a look at the NQs. This is your NQ or the Nasdaq, right? This is your daily. So the daily, this is the best part. The biggest growth sector of the U.S. Economy is technology. We're the best. We're the best. No question about it. In defense and arms, we're the best too. Technology, we're just out there. Like everybody uses our technology. So if you look at the moving averages, they're still trending higher. That's why Apple bounced like it did. So Trent just posted FX.com, China to cut import tariff on auto, some consumer goods. There you go. So I don't know, I'll read that, but that's great. Thank you, Trent. It's on Bloomberg. So so this is where we are. All right, that's your picture in there. Now the Nasdaq includes both. This is Nasdaq futures include both biotechs and techs. So let's take a look at the biotech index. This is probably one of the most bullish indices. And remember, biotech is not immune, but overall sheltered from the ravages of a trade war. All right? This is monstrous. This is a swing chart. If you want to think a little bit ahead. What can I say? This is one heck of a candle that I can detect. Look at the size of this candle. This is the IBB, the Nasdaq Biotech Index. And this includes the big boys, the Biogens, the Regenerons, the Amgens, the Gilead Sciences, not the heavy-duty mid-cap and small-cap players that we love trading, like the Blues, the Sage, and all those companies. So this is big. Can everyone see the pattern? And look at the size of this candle. So I'm looking back here and say, when was the last time we saw a size of this candle? We haven't. And that's why the biotechs, even through all this sell-off, they opened up a little bit lower and bang, 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 they went higher during the day. Yes or no? The resounding answer is, the answer is a resounding yes. So there you go. Now, from a trade perspective, the options on biotech stocks are heavily manipulated. All right. So you have to always somehow try to get the price in the middle. They will always try to screw you, excuse my French, with getting you the right prices. They'll have spreads a mile wide, but so swing trades work best if you're playing a directional bet on those biotech companies. Does everyone understand that part? If you're looking to day trade
Yes,
them,
Frank.
oh, thank you, Nick. So what do you call? And then on the, but then you have the runaway type of moves like you had with Sarepta. Which, by the way, if you're an analyst and you're looking at their numbers, like, oh, they missed their numbers, their cash burn is high. Who cares? Like I said, stop being an analyst. And guess what happened? The stock was down a little bit, and then it ran up $4 in the middle of a huge market sell-off in the morning, and those options went along with it. So this is a very powerful chart. And I think the biotech index is ready for a substantial breakout over the 112 number. So focus on the individual stocks, selective stocks that I played on it, and your own ideas too. XBI is basically the biotech ETF that is also showing similar pattern, and that is the XBI is basically the mid cap, right? It's the mid to the secondary players. How about that? The secondary players of the biotech index. So again, look at the size of this candle. The last time we had one was here, and it continued to move higher before you had that plummet. And this plummet had nothing to do with the biotech index. This huge, ugly candle was the volatility trade blowing up at the on the first week of February. So this is extremely bullish, extremely bullish. So my opinion is that, and I've said this clearly, that a whole bunch of smaller to mid-cap biotech players and the emerging cancer therapy, the CAR T therapies, the muscular dystrophy, and on what's it called? On the, what's the word I'm looking for? Alzheimer's therapies and things like that, they're going to get bought out. In other words, in simple English, there's going to be a lot of M&A, mergers and acquisitions on the biotech side. So if you are placing yourself, you buy a little bit of each of those, keep on rolling them out every month, because you just never know when one of them is going to go. So they're not day trades, they're really swing trades. I just want to be as clear as that. And every morning, I pray that one of these babies just get bought out. That's it, because it's happened. That's how it happens in that industry. They're very crash rich. They're getting a huge tax break for bringing a huge amount of money from overseas. Trump is not going after them every day now, saying, "Oh, cut prices, cut prices." So that's a good thing. And these are great companies. FDA is being very friendly with the approvals for the right companies. And there's always that risk that if there's a non-approval, the stock drops. But then you have to look at the movement of how it reacts after that. So this is also a very pretty good sign. Let's take a look at the VIX, the Vixen. The Vixen had a huge reversal, guys, on the daily. That's an ugly candle. Now, keep in mind the VIX is a derivative beast. So it can suddenly turn around and go higher on a moment's notice because something, on the other end, something happened. The VIX basically is right now on backwardation. If you look at the term structure of the VIX, read that article I put out there so you understand what term structure means. The forward-looking months are showing a lower, in other words, the futures on the VIX are showing a lower number than where we are right now, which means they're saying things are going to be calm there. But I don't really buy that much because the guys who are, obviously there's some, they're not piling into the forward VIX calls and stuff like that. But how the heck do they know? We could be a lot lower 2 months from now. So anyway, it's good to know that at least the institutional players are not betting on a massive VIX rise. I am looking at the short to intermediate term. On the short term, we are seeing a huge reversal, inverted hammer reversal of the same level, which was 26. Best we can get down towards the VIX, to be honest with you, like I said in one of my webinars just a few weeks ago, we're going to trade between 15 and 20. And 20 and 26. So this candle is definitively technically bearish, which means we'll probably go down a little bit more before we move up again. Okay, just the way it happened here. We went down for another day or two, and then I start to see any green candles on the daily on the VIX. I'm going to show it to you guys. That means that means the market lost juice. It's going to go down. So the VIX is critical. I always have one of my VIX screens open. Sometimes it's tough to read on the 1 hour chart or the 15-minute chart because they're moving around rather rapidly. But on the daily chart, you can see what's going on. It is now retesting this upwardly rising 5-day moving average. So it ain't over yet, but that's negative. And that's why you had a 300-point rally in the market. Complete reversal on Friday. We'd like to see a VIX red candle expansion. That's, you don't need to be a rocket scientist. You see the VIX candles come falling, that means the markets are going to go higher. You see moves like this, that means the markets are going to go lower. It's really as simple as that. So you want the macro direction of the market, look at my structured charts, keep an eye on the VIX. And I put out the VIX as needed. Let's take a quick look at the 10-year government bond deal, which was everyone's soup du jour, right? It was the fashionable thing to talk about. Well, let's take a look at it on a weekly basis so we have an idea what the heck's going on. So I told you we'd get up here and create a small flag, and that's exactly what's going on. This still doesn't give us a bigger picture. This does. There you go. Remember what I said. Pattern completion at 3.39%. Now, during times of big stress on the market, big money goes for safety. They're going into the bond market, into the 10-year bond, 30-year bond. They're sitting there. It's like a money market account. They're sitting there, earning the yield, right? At this 0.2%. So, which is a very nice yield to get, to be honest with you. So that's the reason why, as money flowed in there, prices of bonds went up, the yields went down a little bit. Everyone understand that? So that's good. So at this point, the 3% is still there. As long as we don't have a very sharp spike like this caused anxiety in the market, right? We had that big sharp move down that was this was caused on, look at the date down here, on the 29th of January, and that's exactly when the market peaked and market fell right there. So we don't need these type of candles on the 10-year. Small candles like this, okay, no problem. No problem. So we're okay with the 10-year bond for now. Now it's all about Trump, his tweets, aluminum, metal. We don't want too much of the hawks going crazy over China and Canada. All right? Because they ain't giving any exemptions. They said that. Peter Navarro said that. And Navarro's always been a hater of China and stuff anyway. So bottom line is that he's known as one of the, he's a UCLA professor. He's always pissed on China for years and years. And so he's, so it's not like anything new about that. All right. Any other quick questions? I think I covered quite a bit. Questions? Got to wrap up.
I don't have any, Frank.
Okay, sounds good. You look like you need some sleep too. No questions? Good. So I think we covered a lot of broad topics. Futures right now, this is the final look. We're here. Let me clean this out. And this is your weekly chart. Okay, this is your weekly chart of the U.S. financial markets. We need to regain back this 20-day moving average, and that's above 26. That's around 26.88. 1 second. We're right there right now. All these lines, and this is the final point I want to make to all of you. All these lines, which are the highways that carry this market higher, are all still trending higher. All trending higher. We are seeing volatility. That's why you're seeing these red candles. Okay? Now, Look at the internals, which will tell us. So this is all good on the structural basis. We could come all the way down to 2,500 and still be in a bull market. We break 2,500, end of story. And as long as these lines are trending higher, that's the bigger picture. The short-term picture is determined by the 5-week moving average, and that is trending down. So if we get up to about 2,700 and this is trending down, you gotta sell, or you gotta short. This was starting to turn till the tariff crap happened. This was starting to turn. Generally, it should find a home somewhere at this range, which is around 40. We are at 50. So that means we still have some downside left. All right? We'll probably get that tomorrow morning, going into Tuesday. We'll probably get that going into tomorrow, going into Tuesday. Tactical trades, there'll be abundance of opportunities. Short-term, short hedges, abundance of opportunities on the intraday side. I don't like going to bed with a lot of puts in my book. At a few that we did Thursday, Friday worked out great. You go way too many puts on with you in the thing, you're going to wake up in the morning and you're going to cry because they're going to blast the markets higher for no other reason other than to blast you out of your puts. Because if you did it, then a lot of other amateur retail traders did it. And the machines are going to blast you out. And you don't want that. Do you want some hedges? Absolutely. VIX hedges are a good way to go. They're cheap. They tend to move. SPX puts and calls are much faster. But puts in general, got to be careful. That's where we are, guys. So on that note, have a great evening. I got to upload this. It's going to be a very busy week. God bless you all. I think I made my points. And the most important point is that if you're looking for an all clear sign, there are none. If you're looking to make money off my tactical charts and my alerts, there are many. And that's a fact. Have a great evening. God bless you all. Good night.